What is going on, guys? In today's short video, we're gonna take a close look into the ongoing controversy regarding China crackdowns against good Chinese stocks to buy. Let's try to find some best Chinese stock to buy and watch as Beijing crackdowns continue. After all, profit-taking opportunities seem to be growing juicy and chunky for many great dips to buy along the bottoming of many Chinese stocks after a series crackdowns. China is the world's most populated nation and the second largest economy with the booming urban middle classes and amazing entrepreneurial activity. Over dozens of Chinese stocks are among the top performers at any given time across an array of sectors. But in the past half a year, with China government's crackdowns on technology and education firms and other sectors, US-listed Chinese stocks have been hammered in recent months, adding to the weak 2021. While Beijing has signaled that it would like stock and financial market to stabilize, it's also continuing to impose restrictions and increase oversight on the private sectors. As the world's largest internet market, it's no surprise to see big growth from China stocks focusing on Internet of Things like e-commerce, communication, and mobile gaming. Here are some of the best Chinese internet stocks to follow. Alibaba with the ticker BABA, JD.com with the ticker JD, Pinduoduo with the ticker PDD, and Tencent with the ticker TCEHY, Baidu with the ticker BIDU, NetEase with the ticker NTES, Trip.com with the ticker TCOM, and Bilibili with the ticker BILI. As for electric vehicles, several Chinese companies are becoming serious rivals to Tesla in the world's biggest auto market, including NIO with the ticker NIO, Xpeng Motor with the ticker XPEV, Li Motor with the ticker LI, BYD Corporation with the ticker BYDDF. In financial sector, some good Chinese financial service and brokerage firms are listed in the US market now, such as Futu Holding with the ticker FUTU, ARKEK Holding with the ticker TIGR, 360 Digitech with the ticker QFIN, Noah Holding with the ticker NOAH. Besides, for-profit education Chinese stocks are in the notable non-tech sector as well, like New Oriental Education with the ticker EDU, All Education with the ticker TAL, 17 Education and Technology Group with the ticker YQ, and Gaotu Tech Education with the ticker GOTU. Also, please don't forget stocks in other fields such as ride-hailing firm DIDI Global with the ticker DIDI, beauty product maker Yatsen with the ticker YSG, or data center operator GDS Holding with the ticker GDS. Along Beijing crackdowns, investors should be aware of the potential risks of investing in Chinese stocks. The authoritarian states and its regulators can impose sweeping restrictions, fines, or bans on major companies often with little notice or transparency. That risk has become very apparently over the last several months. Alibaba first faced the crackdown in late 2020, with regulators opening probes into internet platforms and suspending the Ant Group IPO last year. Alibaba affiliate Ant Group, limiting the scope of some of its businesses to comply with regulators' demands. In this April, Chinese government fined Alibaba for about $2.8 billion for anti-competitive actions and ordered it to change various practices. In this June, China's cybersecurity regulators ordered to remove DiDi mobile app just few days after DiDi Global's IPO just held in the US market. The cybersecurity regulators say that DiDi violated regulations on the collection and the usage of personal information, but didn't offer any specifics. That came just few days after announcing a probe and ordering DiDi to suspend new user signups. More broadly, China imposed cybersecurity reviews on internet and data-centric companies listing overseas. Hong Kong listings appear to be exempt, suggesting far fewer Chinese companies listing in the US going forward. So far, many big US-listed Chinese companies already have secondary listing in Hong Kong right now. For-profit education firms, including New Oriental Education with the ticker EDU, TAL Education with the ticker TAL, and Gaotu Education with the ticker GOTU, just crashed on July 23rd as Beijing was considering whether to make after-school tutoring firms non-profit. These stocks had fallen sharply this year earlier as new restrictions were signaled. Beijing later confirmed the restrictions, triggering continuous losses in Chinese education stocks and further drops among all Chinese stocks listing in the US market. China is also setting new rules on app-based delivery firms and has signaled that it may target the property sector as well. Finally, Beijing has hinted at even tougher rules for Hong Kong and Macau as well. On August 3rd, Chinese state media criticized online gaming as spiritual opium for adolescents. China has cracked down on online gaming industry previously. Tencent, NetEase, and Bilibili were big losers. On August 10th, the Communist Party's Central Committee issued a new 5-year plan that calls for greater regulations across a broad scope of businesses and the entire economy, triggering further fresh drops on all Chinese stocks. Besides all the crackdowns, Chinese stock risks continue, while accounting fraud also remains a concern, although less likely with institutional quality names such as Alibaba. Last year, Luckin Coffee, with the ticker LKNCY, admitted to widespread accounting fraud. Fraud charges alone can trigger massive share price losses. Meanwhile, a new US law could force Chinese companies to delist from US market. The threat isn't imminent and could be avoided with negotiation between the US Treasury Department and the China regulators for accounting oversights. Still, it's something that could turn big for Chinese stocks in the coming year for accounting fraud. The SEC has temporarily halted US IPOs and some other security sales of Chinese companies as they expose new investors to potential risk of regulatory crackdowns. Sounds scary risky to invest in Chinese stock, right? For many investors, other than those top Chinese single stocks, one way to minimize risk is via ETFs. Another advantage of buying ETFs is that a growing number of Chinese companies are listing in Hong Kong or Shanghai instead of US only. Buying Chinese ETFs helps a lot for those traders and investors without much time and interest focusing on many Chinese single stocks. Here are some good Chinese ETFs to follow. Trend Share CSI China Internet ETF with the ticker KWEB. It tracks major Chinese internet companies. Many Chinese stocks holding in the KWEB ETFs are US listed or traded, such as Alibaba, JD.com, Tencent, Pinduoduo, and Bilibili. But KWEB ETF also holds Chinese stocks listed in China markets to have more comprehensive coverage for better portfolio and risk management purpose. Besides, Direction Daily FTSE China Bull with the ticker YINN is a 3-time leveraged ETF of the 50 largest companies listing in Hong Kong, including Alibaba, JD.com, and Tencent, but with biggest weights in financial sector though. On the other hand, the Direction Daily FTSE China Bear with the ticker YANN is a 3 times leveraged reverse ETF shorting Hong Kong's biggest company. As always, investors should be following the overall stock market trend, adjusting exposure and confirmed uptrend, and managing with more cash to buy the dips in a correction or bear markets. After all that, I hope you could be able to better spot some opportunities among the US and the Chinese stocks. As for now, the US stock market rally remained under pressure, while there are some juicy sweet discounts for buying some good dips from Chinese stock. I will research further to dig out some more precise and concise information regarding how and what to trade and invest for some good profits from Chinese single stocks. Please follow me closely and never forget to hit the like and subscribe button down below this video with any of your thoughts and comments so we can discuss further. Okay guys, once again, thanks for your time and watching. Let's try to find out more in the next one. See you.